Welcome to Smashhead here, where we explore the topics we need today in order to create the future of tomorrow. Today's topic is inflation. It seems like everywhere we look these days, on every news outlet, we see and hear this mysterious word, inflation. I think most people have a basic understanding of what inflation means, as in the cost of living is rising, or that money isn't worth quite as much today as it was just a few years ago, but there are a lot more subtleties involved in the subject that you may benefit from knowing. So although it may seem like some of the people around you are pretty sure of what inflation is and how it affects them, do they really? Do you? If you don't, you're in luck, because in this video, we're going to explore what inflation is, how it works, how it affects everybody, and what type of options you can use in order to protect yourself against its eroding effects and maybe even profit from it. In economics, inflation is typically defined as a decline in purchasing power for a given currency, causing the prices of goods and services to rise over a given period of time. Now, that is one accurate definition of what inflation is, if you know what purchasing power is in the first place. So let's have a look. Purchasing power refers to how many goods and services a given unit of currency can purchase at a particular point in time. These goods and services refer to things we need to live, like groceries and gasoline and utilities. Over time, this same given unit of currency purchases fewer and fewer goods and services due to inflation. Now, that may not have cleared things up for you, but that's okay, because it leads us away from this academic definition of what inflation is and takes us to its real life, tangible definition, which many of us are painfully aware of. In real life, the average person experiences inflation as a discrepancy between their unchanging wages and the price of everything around them rising continuously, relentlessly, one might even say. But as we'll see, just raising wages in sync with inflation won't necessarily solve the problem. In fact, it can make things worse. Okay, so I feel like it's still nebulous. Like, what is this percentage we keep hearing about anyways? I mean, inflation may be up 6% year over year, but what does that mean? What is this percentage measuring exactly? Well, I am glad you asked. One of the reasons inflation is so difficult to even define is because it's difficult to accurately measure. Tracking the price of individual goods and services is relatively easy, but inflation attempts to track the price of everything, the whole diversified lot, from the price of raw materials to milk to the plumber coming to unclog your toilet. And it attempts to whittle all of that information down into one single percentage point expressed against what the same equation yielded at a previous date. Now, no country wants inflation to rise at an uncontrolled rate, so the chief financial authority of a country, like the central bank in the United States or the Bank of Canada in Canada, will attempt to actively try to manage inflation by controlling the influx of money into the economy, typically by raising interest rates in order to discourage the borrowing of money, because it'll be more expensive to do so until inflation comes down and interest rates can come back down, thereby encouraging the borrowing of money in the form of credit. It's important to realize here that sometimes trying to control the rate of inflation can often be like standing chest out against a tidal wave. In that case, there isn't much anyone can do. A real-life example of this happened in Zimbabwe in 2008, when their year-over-year inflation rate skyrocketed 89.7 sextillion%, leading to the complete abandonment of their own currency as legal tender. That's 7.96 times 10 to the power of 10%, for those of you who speak scientific notation. Now, some may point out that inflation is more volatile in developing countries, but hey, according to history, all kingdoms fall, and probably, ultimately, from some form of hyperinflation. The root of inflation is caused by an increase in the supply of money into an economy. Now, that might sound straightforward, but it can happen in various ways, some of which are, of course, easier to track and control than others. In all cases, though, the addition of money into an economy devaluates whatever money already exists, thereby diminishing its purchasing power. Many modern economists believe that there are three types of inflation drivers. These are called demand pull inflation, cost push inflation, and built-in inflation. Let's have a quick look at these so we can understand how they affect our economy and thereby our day-to-day lives. Demand pull inflation, like basically everything else, comes down to the law of supply and demand. This type of inflation is caused by providing more money and credit to people and businesses, which creates a higher demand for a limited amount of goods and services. And since people have more money to spend, they are willing to spend more in order to secure those goods and services that they want, thereby raising prices. The crucial word there is limited. Economics is the study of the relationships between people and scarcity, or a limited amount of things. So, higher demand for something causes less flexibility for the provider, which causes higher prices. Cost push inflation is caused by rising prices, specifically in the production process. All sorts of events can cause this to happen, but it typically begins in the stock and commodities prices, where people basically bet on the future price of everything, particularly things like sugar and meat and oil, sometimes driving the prices to unsustainable levels. These changes affect real-life production costs and can trigger a cascading effect where the prices of related goods and services rise and continue to rise until that cost is inevitably passed on to the consumers of said goods and services. Now, that was just one scenario of how this happened. Another one we are currently all very familiar with is supply chain issues. If you've been outside in the last year and a half or so, you may have noticed that there are certain items which are basically impossible to get your hands on, and if you can, they come at extraordinary prices. Another example is the near impossibility of getting your hands on a graphics card due to crypto miners placing enormous demands on that market, basically driving the availability to zero and prices to infinity. Built-in inflation basically comes down to psychology, but I mean, what doesn't? In this case, inflation is thought to occur specifically because people expect it to. People expect prices to rise over time, so they ask for higher wages. Higher wages creates a higher demand on goods and services, which creates less flexibility for the providers of said goods and services, which causes them to raise the prices in order to meet the increase in demand. A need for more labor, more equipment, more space, more resources costs money, and typically costs more money today than it did yesterday. This creates what some call a wage price spiral. The system basically traps itself in an infinite loop where raising wages causes prices to rise and rising prices causes wages to rise over and over and over again. The percentages we see pasted all over the news are produced by what's called price indexes. These are basically a collection of data from a diversified but still kind of focused or themed array of goods and services. If you know what a mutual fund or an ETF is, the idea is similar. One popular price index is called the Consumer Price Index, and this one focuses on consumer needs, things we need to live like groceries and oil and utilities. It measures the inflation rate according to certain calculations that we won't go into today because the video would be far too long. Another popular index is called the Wholesale Price Index, which tracks the prices of things before they hit the retail level, so wholesale. And finally, there is the Producer Price Index, which tracks, you guessed it, the price of raw materials and various other things that manufacturers use in order to produce products to be sold to the consumers. I'm simplifying pretty heavily here in the name of progress, but hopefully you get the idea. Economists look at these diversified baskets of goods and services from different angles, they perform various calculations on them, and then try to extract some sort of useful knowledge from it all. Inflation is a great buzzword to club people in the head with while screaming about the end of the world, but depending on your circumstances, inflation can actually be a welcome circumstance you salute the sun for. Inflation, similar to compounding interest, can actually be a very lucrative side effect to certain investment vehicles. Owning stocks, for example, is a fantastic way to protect yourself against inflation because the price of stocks already include the effects of inflation. Price is only realized when it's sold versus just keeping your money in a savings account where, aside from minimal interest, that money is worth less and less with every day. When you take your money out, it's still only worth basically what it was when you put it in there. Real estate is another example where the side effects of inflation are a welcome circumstance because when you sell your ownership to that property, it is converted into cash today, not the cash that you used to purchase the property 20 years ago. Beyond those, there are various other inflation-hedged investments out there, but the bottom line is, if you're not dumping your money into some sort of investment in order to protect yourself against inflation, then you are paying full price for it. Holding on to cash, either physically or in a bank account, means that your purchasing power, your participation in the overall economy shrinks every single day. And it causes some people and businesses to sometimes take enormous and sometimes irresponsible risks in order to counter the effects of inflation. But by that point, it's usually too late. And of course, there's a new world on the horizon which threatens the whole of the financial world. I'm speaking, of course, about crypto. Am I advocating dumping all your money into crypto in order to protect yourself from inflation? No. Crypto is a new and growing thing, and it has a long way to go. What I am pointing out, however, is that as economies around the world are beginning to experience some pretty heavy turbulence and uncertainty, many people with many dollars aren't quite sure what the difference is between the volatility of the crypto market and the stock market. What's the difference? It's important to realize here that too much inflation is considered a bad thing for an economy, and so is too little. In general, a healthy, stable economy aims for an inflation rate of 2 to 3% year over year. Things are a little strange out there these days. It's difficult to figure out where you should place your money for you in 20 or 30 or 40 years from now. All investments are inherently risky. Even a bank account is only safe as long as banks don't fail. Equities are safe until the stock market fails. The only thing any of us can really do is research and take our best guess. But, real research, not a YouTube video. So that's it. That is the exciting world of inflation, how it works, how it affects everyone, and what type of options you can use in order to protect yourself against its eroding effects and maybe even profit from it. If you like this video, make sure you let YouTube know by hitting the like button, and if you'd like to see more of these videos in the future, then just go ahead and hit the subscribe button while you're right there. And with that, thank you for your time.